I think that the stock market is going to have a problem because if the market is about higher rates and it's being suffering from higher rates, and you're right, in June to August it rallied 17%, the S&P 500. And what was the narrative? The Fed's going to pivot. All everybody wants is they want the Fed to stop raising rates, and they think the stock market can take off. What does that tell me? It tells me that the stock market's not cheap. It tells me it has no value. It tells me that it's just a speculative vehicle. And please, Jay, allow the speculative juices to start flowing again. That's a bad bet in this environment because I think he's not going to let the speculative flows. To quote Mohammed Al-Arian yesterday, I mean, there's only two things that are going to get the Fed to stop at this point, or three. One is there's some solid evidence that inflation is falling, but that's not going to happen anytime soon. It's going to happen next week. The another one is that you have a financial crisis or you have a bad recession. Well, if you have a financial crisis or bad recession, don't touch stocks. They're going to get slaughtered. And then eventually they'll bottom because we had a financial crisis and or a recession, and then they'll rally. And they probably won't even rally back to these levels if you're not careful. So the stock market has got a lot of headroom. I don't hear a lot of people saying, just buy stocks for very cheap. But let me throw out another idea at you about the stock market. I've kind of teased this idea that inflation is persistent, and I'm going to channel my inner Zoltan Pozar. What has happened in the last 2 years is three major trends that have led to low, stable inflation, interest rates at zero, economics being very stable and booming markets, has been cheap labor, cheap goods, and cheap energy. All of those are ending at the same time. Cheap labor. You've probably heard of quiet quitting. You've probably heard of the Great Resignation or the lie flat that was during Omicron when we were all going to do work from bed. I'll give you one statistic. The Partnership for New York City has been surveying New York Manhattan offices, and the September numbers came out, and there's still only 9% of Manhattan offices are full-time, 5 days a week. 16% of Manhattan workers are full-time at home. So let me make a statement to you. The era of 5 days in the office is over. It is over. We are now in the office some period less. And by the way, I know people say, oh, you wait for the recession, then they'll be begging back for the job. No, people attach a monetary value to working from home. In a recession, they'll give you more days at home because it's a way to give you a raise without shelling out money. But this is not new. We used to work on the farm 150 years ago. That was tough, dirty work. We hated it. We moved to the factory. Then that was tough, dirty work. We hated it. We moved to the office. Now we're moving away from the office and we're moving to the digital world is really what we are. So this is a fourth wave that we've seen of this. This is not new. But what it is leading to is people are not valuing the nose to the grindstone in the office. You're seeing 11 million jobs open, 5 million unemployed, 3.7% unemployment. The day we're recording, the initial claims came out under 200,000. I hear everybody saying, well, the jobs market's falling apart. No, it's not. The initial claims is at an 8-month low. We've printed 300,000 jobs every month. We have a 3.7% unemployment rate. The problem with the jobs market is it's not falling apart. Now, that doesn't mean it won't in the future, but it's not now. So there's no reason for the Fed to stop. That's leading to wage growth of 5% a year. So you're getting a 5% raise, more like 7 or 8 if you switch your job, more like 3.5, 4 if you keep your job. If that's really what we're having, a 5% wage world, we can afford 5% inflation. Companies are bidding for workers. The era of cheap labor is over. Cheap goods. $9 trillion of goods over the last 25 years have come from Asia. 6 of that $9 trillion has come from China. People were willing to accept the lowest possible pay for a job because they wanted a job and they were going to work hard and move up. That attitude has changed. They're now wanting to work from home a lot more. The offset of that was, here's a bunch of cheap crap, and that's a technical term that you can buy at Target or Walmart, and to offset the cheap labor that we weren't paying you a lot of money. We are having all kind of problems with China, and there is an axis forming between China and Russia that maybe we're not going to go back to. Don't worry, the Chinese are just going to crank out cheap crap and put it on boats and send it to the U.S. and we're just going to be swimming in all this cheap stuff that we can buy. That era is over with as well too, I think. And then cheap energy. The biggest energy producer in the world by country is Russia. And we're not going back. There's going to be no deal, and Russia is going to then open the spigots and send in cheap gas to Europe. Hell, they broke Nord Stream 1 and 2, and I've heard that they may never be able to fix them, that they're broken so bad. Or if they do, it's going to take a very, very long time to fix them. And now Zoltan has pointed out that European manufacturing has taken $27 billion a year of cheap energy from Russia and turned it into $2 trillion worth of goods. And all manufacturing, it's the access to cheap energy not labor, cheap energy.
Yeah.
So I shudder what's going on in the Stuttgart plant making Mercedes. The price they're paying for natural gas and the price they're paying for energy to make Mercedes, it's got to make their cost basis a mess right now. All of those eras are over. This is why I think we have persistent inflation. What does that mean for financial markets? For the last 15 years, what you could do in financial markets was buy ETFs, buy spiders, buy XLE, the energy ETF, buy some version of some broad-based index, and wait for the Fed to drop rates to zero and print those higher. Right. I think we're going back to a 70s, 80s, 90s, early 90s, a George Noble type of environment. You know, he was a disciple of Peter Lynch type of environment, where it's back to stock picking. It's not going to be, oh, I'm bullish on energy, buy XLE. It's going to be, I'm bullish on energy. Which stock should you buy?
Yeah.
Because if we don't have cheap energy, if we don't have cheap labor, and if we don't have cheap goods, not every company can deal with that equally. When we had all that stuff that was cheap, all the healthcare stocks were interchangeable. All the energy stocks were interchangeable. They're not interchangeable anymore. We're going to have to go back to stock picking in the next several years. And let me make an inflammatory statement. Your average portfolio manager doesn't do that, doesn't know how to do it. Oh, they all think they know how to do it. They pass the CFA. They pick sectors. They pick ETFs. This is an art form that they have not had to use for decades. And I think we're going to have to go back. So it really comes down to, are we in that regime change of cheap goods, cheap energy, cheap labor? I think we are. And so we're going to have persistently high inflation and we need to transition to a new type of world. Or do you still think like the street, no, this is just a reopening thing and it's going to go away in 2 years and then we'll be back to where we were in the past. So this is going to be the question. This is why what markets are doing with the stress that you see in markets and the losses you see in markets is I think the signal from markets is we're in a period of change. We're in a period of big change right now. And here's the problem. I've used as the example that I think is best overlay for this is after World War II. You had a big run-up of inflation, you had a recession, you had another run-up of inflation. And what happened after World War II was September 45, the war ended. Everybody knew the war ended. Everybody knew the world was going to change. In 1947, when you were coming off the peak of inflation and going down, people were not complaining, when do I get my job back making Sherman tanks? That era was over. We knew that the economy needed to restructure. We went through 2 recessions, 2 inflation waves, and we set off a boom for the 50s into the mid 60s.
Yeah.
Today, in 2022, you'll hear people on Wall Street say, return to normal, get back to the office. So instead of when I say we're in an era of change, we're in an era that things are changing, instead of nodding in agreement and saying, yes, let's figure out how to restructure the economy for this new era, we want to have an argument whether or not we are actually in a new era. And, Dave Solomon of Goldman Sachs doesn't think we're in a new era. He said as much. You get all those lazy asses back to, down at 55 Water Street or 200 West, 200 West, which is their office. And I want to emphasize one other thing about work from home. Right now, pre-COVID, you were home 2 days a week, Saturday, Sunday. Let's say you're 3 days in the office. Now you're home 4 days a week. That's double the amount of time is home. That is enormous. That changes your lifestyle, changes your consumption basket, changes your outlook on life, and everything changes. If you're home 5 days a week and in the office 2 days, it changes even more. I am not arguing that there isn't a need for people that work together to congregate together. They need to. I am arguing that to get on the New Jersey path and smell urine and go to some building on the 38th floor in the cubicle, third row down on the left, that era is what people don't want to do. So sit down and figure out why we need to get together, when we need to get together, and what we're supposed to accomplish when we get together. So that is the problem that we seem to be having right now. We went from the farm to the factory. We went from the factory to the office. We're going from the office to some digital era. This is the fourth time that we've done this in the last 150 years. This is not something new that we've seen before. And what the pandemic did is we were, and I'm going to channel Nick Bloom of Stanford University. He's done the groundbreaking work on work from home. As Nick likes to say, we were moving at about 0.5% a year of the workforce was moving towards remote work from home. In 2019, we had about 4% of the workforce working from home. We had about 8 or 9% of the workforce being hybrid, some days in the office. Today, that's like 16% and like 35%. So what we've essentially done is we've taken a trend that we were going to do and we sped it up 30 years in 2 years. That's what so this is why everybody likes it, because we were going in that direction anyway. We just went so fast, we need to kind of catch up. And that's what we're going to have to do. And like I said, it has enormous implications for everything. The retailers have been having simultaneous gluts and shortages because they're starting to realize people are home. When Omicron ended and Target and Walmart said, everybody's coming back to everybody's going to come back to the store and buy stuff. What do we put on the shelves? We'll put the same stuff in the same proportions that we had on the shelves in 2019. It's 2022. Yeah. And what did they find out? We don't buy stuff in those proportions anymore. Our lifestyle has changed because we're at home 4 or 5 days a week. They're now starting to they've recognized that that's the case, and they're trying to understand what the 2022 consumer wants. And the answer, I don't know what the answer is, but I do know what the answer is. It's not what the 2019 consumer wanted. It's different. That extra couple days at home has changed a lot of things. And I don't think people recognize